So picture this. While most regular investors were happily celebrating around 14% average returns from the S&P 500 over the last 10 years, a smaller group was quietly compounding their money at nearly 37% per year. Let me make that real for you. You invest $10,000 10 years later in the broad S&P 500, you're looking at roughly $38,000 to $40,000. That's respectable. You can buy a nice car, take the family on vacation, and feel pretty good about it. But the same $10,000 in the strongest ETF we're talking about today, it grows to over $238,000. That's not luck. That's not hype. That's what happens when you focus on the real engines driving the modern economy instead of owning everything. Today, I'm walking you through 5 ETFs that have been crushing the S&P 500. We'll keep it simple, look at real numbers, honest risks, and how you can actually use them to build serious wealth. If you want your money working harder for you, smash that like button right now and subscribe. We break this finance stuff down so it actually makes sense. Let's start with the one that's been on an absolute tier, SMH, the VanEck Semiconductor ETF. Meet Sam, regular guy. He put $10,000 into the S&P 500 10 years ago. Today he's sitting on about 38 to 40,000. He feels responsible. He tells his friends the market always goes up eventually. Then there's Muhammad. Same $10,000, same time period, but he went all in on SMH. Today, over $238,000. That's roughly 37% average annual return. Here's what's inside. SMH holds the 25 largest semiconductor companies: NVIDIA, TSMC, Broadcom, AMD. These are the companies building the brains for AI, data centers, phones, and electric vehicles. Expense ratio is 0.35%. The fund manages over $46 billion. Semiconductors are like the new oil. Demand keeps exploding with AI growth, and in 2026, we're still in the early stages. For long-term investors, this is one of the strongest trends out there. But here's the honest truth, it's volatile. It can drop hard and fast during tech sell-offs. If you have a long time horizon and strong nerves, SMH can be a powerful growth piece. Just don't overload your portfolio unless you're okay with big swings. Now, what if you want strong tech growth but a bit less concentration? That's where XLK shines, the Technology Select Sector SPDR fund. Sam's coworker Lisa stayed with the full S&P 500. She got the tech winners, but they were dragged down by slow banks, utilities, and energy stocks. Her friend Jack wanted the fast part only. He chose XLK. This ETF holds the biggest technology companies inside the S&P 500. Apple, Microsoft, NVIDIA, and around 65 to 70 others. Expense ratio is an incredibly low 0.10%. Over 10 years, it delivered around 24% annualized. That $10,000 turned into roughly $88,000 to $90,000. XLK basically takes the S&P 500 and removes all the boring dead weight. In 2026, with companies still pouring money into AI, this one remains a clean and powerful way to own the growth engine without picking individual stocks. Next up is QQQM, the cheaper, smarter version of the NASDAQ 100. You know, the famous QQQ. A lot of smart investors switch to QQQM because it does the same thing but with a lower 0.15% expense ratio. It holds the 100 largest non-financial NASDAQ companies, heavy on the Magnificent Seven and future innovators. 10-year returns have been in the 18 to 21% range. $10,000 grows to about $55,000 to $65,000. Sam played it safe with the broad market. His cousin Fatima added QQQM. 10 years later, she's pulling ahead fast on her financial independence journey. Technology isn't just a sector anymore. It's transforming every industry. For people building toward early retirement, QQQM is one of the simplest ways to own that innovation wave. Now, here's one that flies under the radar: SPMO, the Invesco S&P 500 Momentum ETF. This one is really clever. Instead of owning the whole S&P 500, it only holds the 100 stocks showing the strongest upward momentum right now. It follows strict rules and rebalances twice a year. Expense ratio is 0.13%. 10-year average around 19.5 to 20%. That turns $10,000 into roughly $60,000 plus. Lazy Sam just buys the plain S&P. Momentum Mike lets the system ride the hot stocks and drop the losers automatically. Momentum is a real proven edge. In a world where new AI breakthroughs can shift leadership quickly, SPMO helps you stay on the winning side without doing the work yourself. And finally, the calm defensive player SCHD, the Schwab US Dividend Equity ETF. This one isn't chasing rocket ship growth. SCHD owns 100 high quality companies with at least 10 years of dividend growth, current yield around 3.4%. Expense ratio is an amazing 0.06%. 10-year return is about 12.7%. It trails a bit in crazy bull markets, but look what happens when things get scary. In 2022, when the S&P 500 dropped 19% and Nasdaq fell over 30%, SCHD only dropped about 3 to 4%. It's the steady ship that keeps paying you. Many people use a barbell strategy growth ETFs like SMH or QQQM for upside and SCHD for stability and growing income. The dividends here grow faster than average, which makes a huge difference over decades. Here's the real talk. None of these are perfect. Higher returns always come with bigger drops. They can all fall hard in a bear market. So here's how smart people actually use them on the path to financial independence. Keep investing every single month, no matter what. Treat big market dips as a sale. Build your emergency fund and kill high interest debt first. Mix them wisely, growth on one side and SCHD on the other, so you can actually stay invested when things get rough. The plain S&P 500 is fine for many people, but these ETFs let you tilt toward the real drivers of the future while keeping some balance. Whether you love SMH's explosive potential, XLK's clean tech power, QQQM's simplicity, SPMO's smart edge, or SCHD's steady income, the real secret isn't picking one perfect ETF. It's staying consistent long enough for compounding to work its magic. Which one stands out to you the most? SMH for the AI boom? The barbell approach with SCHD? Drop your thoughts in the comments. I actually read them. But first, do your own research. Understand your risk tolerance and time horizon. Past performance doesn't guarantee future results. Only invest money you won't need for a long time. If this video helped, give it a big like, hit subscribe, and I'll see you in the next one.